The stock market didn't stop caring about companies overnight. It just stopped needing them. Today, a company can grow revenue, beat earnings, expand margins, and still watch its stock fall. Another company can lose money, miss forecasts, and lay people off, and its stock can rally for weeks. That's not broken logic. That's a different system. And the uncomfortable truth is this: the stock market is no longer primarily about companies. It's about something else entirely. Let's start with why this matters right now. Because most people still believe stock prices are votes on business quality, that good companies go up, bad companies go down, and over time, fundamentals win. That belief isn't stupid. It's just outdated. The market you're participating in today was not designed to reward careful analysis of businesses. It was redesigned quietly to manage flows of money at scale. And once you see that, a lot of confusing behavior suddenly makes sense. To understand how we got here, we need to rewind. For most of the 20th century, the stock market really was about companies. You bought shares because you believed a business would grow. You sold because that belief changed. Prices moved slowly because information moves slowly. Even professional investors spent their time reading reports, visiting factories, talking to management. The market reflected collective judgment. Then scale entered the picture: pension funds, index funds, retirement accounts, sovereign wealth funds. Trillions of dollars needed exposure to markets, not opinions. These institutions didn't want to pick companies. They wanted allocation. How much in stocks? How much in bonds? How much risk overall? That shift changed everything. Because once money is allocated by category instead of conviction, companies become interchangeable. A stock isn't a business anymore. It's a unit of exposure. And exposure is managed by rules. This is where the market quietly stops being about companies. Let's make this concrete. When money flows into an S&P 500 index fund, it doesn't ask which companies are good. It buys all of them. When money flows out, it sells all of them. Apple and a struggling industrial firm get treated the same way. Not because they're equal businesses, but because they occupy the same bucket. This logic has spread everywhere: ETFs, factor funds, sector funds, volatility funds. Each one groups companies into abstractions: growth, value, momentum, low, volatility, quality. Stocks don't move because something changed inside the company. They move because something changed outside it: a rate expectation, a volatility spike, a correlation shift. This is the first big break. Price no longer reflects judgment. It reflects positioning. Now add automation. Most large funds don't wake up and decide what to buy. Their systems adjust exposure automatically. If volatility rises, risk is reduced. If correlations increase, diversification disappears. If momentum reverses, positions unwind. These systems don't read earnings calls. They read signals. And signals don't care about stories. This is why markets can sell off on no news. Because something changed in the math, not the business. Now let's talk about speed. Because speed finishes the transformation. When humans dominated markets, interpretation mattered. There was time to argue, time to disagree, time for price discovery. Now price discovery happens faster than understanding. By the time a human processes information, algorithms have already traded it multiple times. So the market isn't weighing company prospects. It's reacting to changes in probability distributions. This leads to behavior that feels absurd. A company announces great earnings. Stock drops. Another issues weak guidance. Stock rises. Commentators scramble to explain why. But often, there is no why in the traditional sense. The stock didn't move because of the company. It moved because of what the company represented in the system. Maybe it was overowned. Maybe it broke a technical level. Maybe it triggered a rebalance. The explanation comes later. The trade comes first. This creates the illusion that the market is irrational. It's not. It's just optimizing for something you're not looking at, which brings us to the hidden mechanism. The stock market today is less a marketplace for businesses and more a risk distribution engine. Its primary function is not to value companies. It's to allocate risk across trillions of dollars as efficiently as possible, and companies are just inputs. This is why correlations rise during stress. Everything sells together. Not because every company suddenly became worse, but because risk needed to come down. This is also why diversification fails when you need it most. Because when risk is reduced at the system level, differentiation disappears. Stocks don't trade on what they are. They trade on what they do to a portfolio. Now let's contrast the hype with reality. The hype says markets are smarter than ever. More data, more analysis, more information. The reality is markets are narrower than ever. They respond to fewer variables: liquidity, rates, volatility, positioning. Company-specific details matter, eventually. But in the short and medium term, they're often drowned out. This creates a dangerous misunderstanding. People think the market is disagreeing with them. In reality, the market isn't listening at all. It's solving a different problem, and this has consequences. One of them is instability. When markets were about companies, mistakes were isolated. One bad stock, one bad sector. When markets are about flows, mistakes are systemic. Everyone exits together. Everyone re-enters together. Liquidity vanishes precisely when it's needed. Another consequence is frustration. Investors do the work, analyze the business, understand the fundamentals, and still lose money, not because they're wrong, but because timing and flows overwhelmed truth. This leads people to chase momentum, to abandon conviction, to assume the market is rigged. It's not rigged. It's just not centered on you or the company. Zoom out even further. What does this mean for capitalism itself? If stock prices no longer reflect business performance in a clean way, they stop being reliable signals. Capital allocation gets distorted, management incentives get warped. Short-term price action dominates long-term thinking. Companies start managing optics instead of operations, because optics move flows, and flows move prices. Ironically, this is happening at the same time we tell people to invest in great companies. That advice isn't wrong. It's just incomplete. Because great companies can be terrible stocks for long periods, and mediocre companies can be excellent trading vehicles. The market doesn't reward virtue. It rewards alignment with the system. So where does this leave the individual investor? Here's the quiet truth. If the stock market is no longer about companies, then traditional analysis is no longer sufficient on its own. You don't just need to ask, is this a good business? You need to ask, who owns it? Why do they own it? What would force them to sell? What would force them to buy? That's not romantic. It's not clean. But it's closer to how prices actually move. And even then, certainty is impossible. Because when markets are driven by flows, they can detach from reality for longer than feels reasonable, which brings us to the final question. If stock prices are no longer clear signals about companies, if they're reflections of positioning, leverage, and constraints, then what exactly are we looking at when we check the market every day? Are we watching the economy? Or are we watching a machine adjusting itself? And if the market isn't really about companies anymore, at what point do we stop pretending that it is?